This stock seemed very cheap, so you should buy it, right?
Kmart filed for Chapter 11 bankruptcy protection this past week, becoming the largest American retailer to seek protection from its creditors, with many stores closed and many jobs lost.
Sears has filed for bankruptcy. It's just ahead of the holiday season, and more stores now set to close as employees are expected to be laid off.
All those news reports are examples of value traps, and that's something you really want to avoid, and we will get to that later, but first, let's start with our main focus here. What's up guys, it's Elran here. Most of you probably heard of the name Benjamin Graham, but if you never heard of him, he was Warren Buffett's mentor, the author of The Intelligent Investor. Many investors call this book the Bible of investing, and Benjamin Graham is known as the father of value investing. Today we're going to check Graham's philosophy of investing, if it really worked for him, and if he really believed in his own investment philosophy, and what Warren Buffett thinks of this approach. The conclusions will be surprising, believe me. When I started my own journey as an investor, the first thing that I did was to try and learn from the best investors out there. Warren Buffett was at the top of my list, of course. So the first thing that I did was reading The Intelligent Investor, because Warren Buffett was so loud about how good that book is and how it's crucial for investing. The book really did leave an impact on me back then. The way that you can value a business methodically and try to find only cheap stocks seems so logical to me. But the more I learned, the more I realized there's a flaw in this method by itself. To see why it's flawed, we have to understand what value trap is. Think about a value trap as a company that trades at low multiples, and all the financial metrics seem to be great, like low price to earning multiple or low price to book value. So it could attract many investors that think they found a bargain, and once the market will find out about it, they will make a profit. But that approach really ignores the state of the company itself. The company could face very low growth potential or a high risk that wasn't there before. And I personally know people that lost money following only the company's financials when the stock seemed to be too cheap, while ignoring the business itself or the risk it's facing. So I tried to understand what I missed, and I tried to find out how Warren Buffett uses this method and how it worked for him. When I dug deeper, I saw that even Warren Buffett recognized this flaw. Buffett wrote in 1989 Berkshire Hathaway annual letter, "I can give you other personal examples of bargain purchase folly, but I'm sure you get the picture. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Charlie understood this early, and I was a slow learner. So you can see that Warren Buffett says himself that buying a business for a wonderful price is just not enough. And it's a little surprising, since that's what the Intelligent Investor book is all about. I decided then to read the Intelligent Investor again and to try to find out what I missed the first time. The second time that I read it with the intention to find out if Benjamin Graham addressed this issue, I found out that Benjamin Graham himself addressed that this method might not be enough, and that buying an undervalued company will not ensure great profits. You can see it in this paragraph. The first two sentences in this paragraph are the most interesting. You can see that Benjamin Graham acknowledges that the major risk in buying securities is buying a cheap stock of a really bad business and not buying an expensive stock of a great business. When reading this book, it's so easy to completely miss this important lesson, and I missed it the first time that I read it. But it doesn't end here. I also found at the postscript of the book an interesting story that could shed some more light on how Graham viewed this issue of value investing. The postscript mentions that Graham and his partner Jerome Newman bought a very large position in Geico, which was only fair priced and not undervalued, but they understood how great the business was, and it turned out to be their most successful investment over the years. At the end of all this book that preaches about how to find cheap stocks, there is this story that Benjamin Graham had his most successful investment in a fair-priced company and not a cheap one. I think it shows how Graham himself knew that investing in a cheap company is really not enough, and there could be great opportunities in fair-priced companies. So, as I mentioned earlier, and as you probably know, Warren Buffett is a huge advocate of Benjamin Graham's philosophy, so it doesn't make much sense from my end, because if it's so so flawed, like I'm saying, how did Warren Buffett become the most successful investor out there? The answer to that will be that he doesn't only use the Benjamin Graham's way to invest, he also uses Philip A. Fisher's philosophy, which also has a book, Common Stocks and Uncommon Profits. Fisher's main focus is on the business itself, and he used 15 points to try and determine the state of a business. He was much less focused on valuations than Benjamin Graham was, and Warren Buffett seemed to find the sweet spot between the investment philosophies of these two great investors. I was able to find this interview with Warren Buffett where he addressed how he uses those two philosophies. Check it out.
Are you still a 15% Phil Fisher and 85% Graham?
I don't know what the percentage would be. I'm 100% Ben Graham in those 3 points I mentioned earlier, and those really count. I was very influenced by Phil Fisher when I first read his 2 books back around 1960 or thereabouts, and I think that they're terrific books. I think Phil is a terrific guy. So I think I probably gave that percentage to, I think I first used it in Forbes one time when Jim Michaels wrote me, and I think it was one of those things I just named a number. But I think I'd rather think of myself as being a sort of 100% Ben Graham and 100% Phil Fisher, in the points where they don't, and they really don't contradict each other. It's just that they had a vastly different emphasis. Ben would not have disagreed with the proposition that if you can find a business with a high rate of return on capital that can keep using more capital on that's the best business in the world. And of course he made most of his money out of Geico, which was precisely that sort of business. So he recognized it. It's just that he felt that the other system of buying things that were statistically very cheap and buying a large number of them was an easier policy to apply, and one that was a little more teachable. He would have felt that Phil Fisher's approach was less teachable than his, but his had a more limited value because it was not workable with really large sums of money.
So we saw that Benjamin Graham himself acknowledged that there is much more to investing than valuations. And don't get me wrong here, valuations are crucial for investing, and I don't think that Benjamin Graham was wrong. For example, if you invested in the next Netflix for a price that's not so far away from Netflix itself, how could you make money from it? I mean, what exactly do you think will happen? It already is priced as a success. So Benjamin Graham will continue to be great and his philosophy crucial for investing, but we as investors should know it's necessary but not enough. Thank you all so much for watching. If you like this video, please give it a thumbs up. It will help us a lot with the YouTube algorithm. This is our new investing channel where you can learn how to invest, find new investing ideas, and learn about the amazing history of some companies and much more. It will mean the world to us if you decided to join our journey and subscribe to our channel.